Welcome to this explainer. Today we're actually building something pretty incredible together. We are laying down the ultimate blueprint for financial independence. We're going to take a real step-by-step journey that bridges your personal finance defense with some heavy-hitting entrepreneurial offense. We'll be pulling the best insights on how to escape those sneaky middle-class money traps, how to secure business capital, and basically mapping out the whole shebang so you can build a sustainable financial empire right from the ground up.
Okay, let's tackle this question right out of the gate, because honestly, it is the ultimate frustration, isn't it? You earn a decent salary, you pay your bills on time, you're working hard every single day, yet somehow you still feel totally stuck in that financial rat race. It's like no matter how much your income goes up, your savings just refuse to budge. Well, if you've ever felt like you're pedaling as fast as humanly possible but getting absolutely nowhere, trust me, you are not alone. The truth is, most people don't struggle because they earn too little. They struggle because they're falling into hidden traps.
So here is our step-by-step roadmap to financial independence. First, we'll identify the middle-class money traps. Second, Step 1, plug the leaks. Third, Step 2, build multiple incomes. And finally, Step 3, fund your business.
Part 1. The middle-class money traps and escaping the rat race. Society sells us this incredibly dangerous illusion. We're basically trained to associate wealth with designer brands, luxury gadgets, and those high-end lifestyles you see plastered all over social media. But honestly, that is just looking wealthy. It's all about appearances. Being wealthy, on the other hand, is a quiet, powerful reality. It's living below your means, leveraging compound investing, keeping a solid emergency fund, and having absolutely zero bad debt. The crazy irony of the rat race is that a lot of the people who look wealthy are actually drowning in debt, while the genuinely wealthy folks are flying completely under the radar. The scariest part about these wealth traps is just how normal they seem. So as we run through these, do a quick mental check to see if any are currently draining your own accounts. First up, lifestyle inflation. This is where a raise just instantly turns into a bigger apartment or a premium subscription. Then there's rolling over credit card debt, where high interest literally mutates small purchases into these massive long-term burdens. What about buying a house before you're financially ready, just because society expects you to? Or endlessly financing cars. You're literally pouring money into an asset that drops in value every single day. Combine all that with relying on just one single income and a dash of financial illiteracy, and well, you've got a perfect recipe for staying broke. Step 1. Plug the leaks. Defense first. There is a massively important truth you have to internalize right now. Wealth isn't created by how much you earn, it's created by how much you keep. Seriously, a raise means absolutely zero if lifestyle inflation just gobbles up every single new dollar you bring in. Escaping those traps we just talked about doesn't mean you need to get rich overnight. It just requires small, consistent habits to make sure you're actually holding on to the cash you work so hard for.
And your absolute best defensive strategy starts right here with this number, 3 to 6. That is a number of months and living expenses you need sitting safely in an emergency fund. Let's face it, life is wildly unpredictable. Medical emergencies, sudden car repairs, getting laid off out of nowhere. Without this 3 to 6 month buffer, you're pretty much forced to rely on credit cards when things go south. And that is exactly how a tiny, temporary setback balloons into a total financial disaster.
So what does this journey from basic survival to true independence actually look like? Well, first, we plug the leaks. We spend less, we avoid bad debt, and we build up that emergency fund. Second, we build the foundation by investing regularly and totally shifting our mindset away from chasing social status. And third, we scale up. Once your defense is locked in tight, you transition into the offensive phase. This is where you create multiple incomes and launch businesses.
Step 2. Build multiple incomes. Going on offense.
You know, successful people always diversify how they earn. They build different engines of wealth. This could be freelancing on the side, investing for compound returns, building an online business, generating dividend income, or even creating digital products. Multiple income streams give you stability and just an incredible amount of flexibility. You're basically putting your saved dollars to work for you like a little army of soldiers. That way, if one income stream suddenly dries up, the others step in to keep your financial engine running smoothly.
But you absolutely have to remember this vital rule. Idle cash loses value to inflation. A lot of hardworking folks save their money, but they never actually invest it. And as inflation creeps up, the actual purchasing power of your cash drops. It's like a leaky bucket. You need to get that cash out of your checking account and into compound interest vehicles.
Invest early because time in the market is literally your biggest advantage. The sooner you start, the more explosive that compounding effect becomes.
Step 3. Fund your business. Scaling the engine.
Almost every successful company relies on some kind of financing at some point. So let's break down how different capital pathways directly impact your ownership and your risk. Bootstrapping lets you keep total ownership with zero repayment, which is perfect for founders who want complete control and have low initial costs. Then you've got bank loans. You still keep ownership, but you do have to repay them with interest, making them a solid bet if you have stable, predictable revenue. Now, investors mean you don't have to repay the funds, but you do give up equity and share decision-making power, which is usually best for high-growth startups. Crowdfunding is an awesome way to test market demand with reward-based backing, meaning no repayment, and finally, grants. These are amazing if you can get them. You keep ownership, no repayment required, but they're typically reserved for very specific, innovative startups, and they are highly competitive.
Now, I want to highlight this percentage right here, 100%. That is the amount of control and equity you retain when you choose to bootstrap your business using your own savings. Honestly, a lot of the world's most famous companies started exactly this way. The huge advantage is that you call all the shots. You make every single decision yourself. The downside, of course, is that your funds might be pretty tight in the beginning, which can definitely slow down your growth. On the complete opposite end of the spectrum from bootstrapping, you have venture capital. This is when you bring in the heavy hitters. These investment firms inject massive amounts of capital into early-stage businesses that show high growth potential. But the trade-off here is massive. Yes, you get the big bucks, valuable mentorship, and incredible business connections. But in exchange, you sacrifice total control. You're giving up a percentage of your company, and you have to share those big strategic decisions.
So, the most important takeaway for business funding is simply this: there is no one-size-fits-all solution. Avoiding the money traps we covered earlier means picking a funding option that actually keeps your new asset financially healthy. If you're just starting out, bootstrapping might be all you need. If you've got steady revenue rolling in, maybe look at a bank loan. And if you have a massive, highly scalable idea, well, investors might be your golden ticket. You've got to match your financing choice to your specific goals, your cash flow, and your own personal risk tolerance.
We've covered the traps that keep people broke, the defensive strategies to plug those financial leaks, and the offensive tactics you need to build multiple incomes and fund a business. Remember, financial freedom isn't about looking wealthy to your neighbors. It's about having actual choices in life. Every smart financial move you make today compounds into a vastly stronger future tomorrow. So, I want to leave you with one final provocative question to think about. Will you buy another liability today, or will you build your first asset? The choice is entirely up to you. Keep learning, keep building, and we'll see you in the next explainer.